Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Thank you for joining me back on another episode of Upticks. This is episode 182, Beating Inflation with Matthew Navickas. And Navickas, we all call you Navickas because we've got two Matthews on the team, but welcome to the show.
Thanks for having me. I'm excited to be here.
This is your world debut. Are you excited? Are you nervous?
There's a little bit of nerves, but more excited. Absolutely.
Good, good. Well, just rest assured, it's only friends watching you and good people So, so before we dive into, your role on the team and things that we're doing in the portfolio, why don't we give our audience a little bit of background of kind of where you grew up, what you went to school, and then we'll kind of get into your group a little bit.
Right. So I grew up in the Kansas City area. I went to Aquinas High School and then attended KU, where I studied finance and business analytics. Now I am here working at Falcon Wealth Advisors, where I actually interned my senior year of college, which was a great experience, and came on full time. And now I am on the research and trading team, working alongside Abby.
And when did you start as an intern?
I started, I believe it was December 2019. I think that's when I started. Yeah.
Really? So
yeah.
So basically 2 years now.
Right.
Awesome. Time flies.
It sure does.
And what is Aquinas' mascot?
We are the Saints.
Oh, perfect. What a better mascot for a private school.
Right.
So good. So then you went off to KU, studied finance. Why did you ultimately choose to get into finance? What intrigued you about that in college?
So I'd always had an interest in finance. My dad and I, when I was in high school, we'd kind of look at companies together, see what we liked and whatnot. And I just grew fond of looking at companies, finding ways to grow your money. And it really intrigued me and fell in love with it. So continue with it, and I'm still enjoying it.
Good. Perfect. So now you are in the research and trading group with Abby. So there's two of you in there that are full-time, basically analyzing the markets, doing the trades. Why don't you talk a little bit about what your day-to-day looks like so our clients know what you're doing for them?
Right. So I would say our day is divided up between two parts. The first part will be Abby and I will come in, we'll look at all the portfolios in our trading software. From there, we'll see if they're out of tolerance, who needs cash invested, who needs cash to raise. And then after we get done with the maintenance of portfolios, making sure everyone's in line with our IPS and their allocation, we will then move and look to how the market is performing. We'll use our Bloomberg terminal to research companies, see what news is out, see what we should be looking forward, stuff like that. That really helps us get a grasp of what's going on in the market. There's a lot of information to consume, but we have a portfolio in our Bloomberg terminal that really just gives us the important information on what we should be looking at.
Yeah, that's really awesome. Yeah, so it's really neat about the technology that we invested in. So literally when you come in to the office every day, you pull up a dashboard and we have every single client. So we have literally hundreds of clients programmed with their own IPS, which stands for investment policy statement. So basically you, in conjunction with us and the planners, have built these I guess allocations out for every client, set the rules up in technology, and then boom, you get alerted if something needs to be adjusted. What's good about that, I think also, is that we're not just relying on the computer to do the trades. You're literally looking at the portfolio when it's out of tolerance, which I think is a great thing, because to me, that avoids a lot of just automatic things going on. And oftentimes you and I, and I'm sure you and Corey will have conversations about, hey, this client's got this going on. What is our advice? What is our strategy? So we can actually look at it so it's not just this automatic program, which is really cool.
Right. Yeah, it definitely helps automate some things, but there's still some manual effort that we put into it to make sure things are customized correctly.
Yeah, you sprinkle on that human touch.
Right. Absolutely.
You don't want to be replaced by a robot. You don't want to do
No.
that. So good. And then again, which we've invested heavily in Bloomberg. In my opinion, it's one of the premier software companies out there. Basically, it takes all the research, all the news, and feeds it into a really kind of cool program that you and Abby have access to, and I do as well. We spend about 25 grand a year per license on that, so it's not something we take lightly, but we're using that to make our investment decisions, which is important because it's it's tough to do. Like you said, it's a full-time job. There's a lot of data out there, and to have a resource that can kind of consolidate that for us to help us make good decisions, I think is extremely important and certainly worth the investment. Now, also for our clients, I know this is kind of something new. We've also been sending out your commentary every quarter, right? So why don't you talk about what goes in that email that you're sending out only to clients, right? But what goes into that email?
So in that email, we will have just what we had done throughout the quarter. So whether that be a buy low, so when a company's RSI drops below 30, we find that an attractive time to buy. We will note that in our quarterly email. We'll also note any swaps in the portfolio. So if we decided to move out of stock A and into stock B, we'll provide why we wanted to move out of that stock and into stock B. So we just give some good guidance on what we're actually doing day to day for our clients. We also will provide a nice glossary of all the stocks we are invested in and a little description of what we have, what those companies do, just to give our clients overview of what's going on. So it's not like a mutual fund where you're not sure what you're in, what's going on in the portfolio. We give you a clear, cut and dry detail of what's going on.
Yeah, thank you. I think that's really powerful. So it's very important for clients to be on the lookout. That'll typically go out, it's already gone out for January or back in January. So the next one will go out mid-April, right? And then mid-July, mid-October. So that's the idea, is that it's a really neat summary. You guys do a great job of tracking everything. So like you said, all the buys and sells. So not only are you getting that data from the custodian, and for most of our clients, we're using Charles Schwab, but what we're doing is, rather than just tell you what we did, like you said, you're giving some color and commentary behind it, which I think is awesome. Then probably the third thing that you and Abby do before we get into how we're going to beat inflation is you guys will talk to clients and you'll call clients, right? Which has been hugely impactful to our clients, meaning that they don't have to necessarily wait to get on my schedule for a simple investment question. So maybe you can talk about some of the conversations that you have with clients regarding their portfolios.
Right. So Abby and I are more than happy to, whenever a client needs to talk, we're happy to discuss, try to explain things better to them. I know things can be confusing, especially if we're not working with it day to day. So we're happy to go ahead and explain what's going on, whether that be a concern about what's going on in the market or how your portfolio is structured, or if you just have a general question, feel free to send Abby and I an email or call us. We are happy to discuss.
Yeah, that's great. That's been huge, certainly. And I think our clients we got some really good feedback. They really value being able to have that conversation versus getting on my calendar or Corey's calendar for a full meeting. So again, all of the strategy and the advice is still really coming from Corey and I. Matthew, though, and Abby are putting in heavy input on the research, and then they're just executing it. And it's pretty fun. And in fact, every week, we have an investment committee meeting where we also talk about the portfolio internally. So we'll talk about what's working, what's not working, option strategies, our stocks, our bonds, and make sure that we're on the same page. And then you guys just go out there and execute it, which has been awesome. All right, so let's talk about the topic of the show. So inflation, right? If you pay any attention to the market or the economy, you know that inflation is here. It's running at what, 6 or 7% now?
Yeah, the last report we got on an annualized rate was around 7%.
Yeah, so many clients have been asking me, Jake, what are we going to do about that? Now, I certainly talk to them from the planning perspective, but the topic of today's show is what are we doing from an investments perspective? So maybe Matthew, you can comment on some of the things that we've already done because we already are in an inflationary environment.
Right. So obviously inflation's here. It's not transitory. It's fueled by a number of things, whether it be stimulus, quantitative easing, or the supply chain shortage. So it's definitely here. And the things we're implementing now is that with inflation, that means that the Fed will be forced to kind of normalize that inflation number down to around, say, 2%. So there's a lot of work to be done. So in order to do that, they will have to raise interest rates. So what we're doing here in anticipation of those rates increasing is we're looking at a few things. We're looking for companies that are very strong, stable companies or growing fast. We want those companies to have a strong free cash flow so that they have the money that they're generating to go ahead and reinvest into their business or pay out to shareholders instead of having to go out and borrow at these higher interest rates that are going to be coming. Also, another thing is that a lot of companies, they are valued off their what's called a discounted cash flow. So as these rates will rise due to inflation, the value of these companies will go down as the reference rate, or like the treasury could be a reference rate for the risk-free rate that will be used to discount against these companies. So essentially what that means is that money that companies are generating now in the present are worth a lot more than the future cash flows of these companies that say aren't generating any money for up to 10 years out in advance. Those companies are going to be really affected by these rising interest rates.
Right, because they'll have to, well, real quick, because they'll have to go borrow money, right? And so if they don't have the money, like you said, to reinvest in their business, that hurts them. But go ahead. What were you saying next?
Right. Yeah, that's exactly right. They'll have to borrow the money. They'll also, and just on a valuation scale. So if this was, let's say it was just a firm that values everything using an algorithm, whatnot, and they're taking a look at just the cash flows that the company will produce, that algorithm, that computer software they'll have a new value for that company in 3 months compared to right now, because interest rates will likely be higher in that 3 months. So what we're doing with our bond portfolio, as we do see rates starting to rise, probably likely in March coming up here, the next Fed meeting, we are looking to lower our duration of our bonds. So what that means is duration essentially tells you when those cash flows are going to be coming due. So the factors that will factor in there will be the interest payment that comes likely it's semi-annual, so twice every year. That'll factor in. But the main contributor to the duration period will be the repayment of the principal amount. So a duration of 10 years. So likely that means that it's a 10-year bond will be more affected by rising interest rates than, say, a 3-year bond. The reason for that is because once you receive that principal repayment, we will be able to go ahead and reinvest that into higher interest rate bearing bonds.
Right. Yeah. So that was good. And that's a lot of information. So on the stocks, we've already adjusted looking at the discounted cash flows, the free cash flows, right, and all of that, because we know that needs to get priced in. And then the Fed. So I was just reading an article this morning or an email that said it's been since, I think, 2000 since the Fed has raised rates more than 0.5% in one go round. So we're estimating, I would say, that you mentioned March. So we think the Fed's going to raise rates in March, probably 0.25%. Is that what we're thinking?
Yeah, that's still up in the air. It's 0.25 to 50 basis points, but that's still up in the air. And that's what I think the market right now, with the current volatility, that's one of the main things that I think is causing all the volatility. Is just the uncertainty. Investors are trying to anticipate what's going to happen. And until we know that information, that we're going to continue to see some volatility here. So only time will tell, as they say.
Right. And we know they're going to raise, though. I mean, they've already kind of commented on that. So we think they're going to raise maybe 3 to 5, or what would you, if you had to place a bet on it, what would you say? How many times?
If I place a bet on it, I would say 3 to 4 times. I have heard all the way up to 7 times, but 7? I think that's a little crazy. So I'm leaning more towards 3 to 4 times.
So currently the Fed funds rate, which is the rate that basically they use for banks to borrow money, is around 0, right?
Yep, 0 to 25 basis points.
Right. So if they raise 3 to 4, so we're talking it going from 0 to 0.25% to 1%, right? Plus, so it's not. It'll tighten the economy, right, very much, but it's not like interest rates are going to jump up to like 10% for a mortgage all of a sudden, right? I mean, they could. But that also maybe bodes well that if somebody is looking to get a mortgage now, is probably a better time to do it than a year from now. When you say, I guess
absolutely, yeah. If you can find a house you like for a reasonable price, I know that's kind of few and far between right now. Now would be a great time to go ahead and lock in a rate at these all-time low interest rates.
Right. So that's one way to help beat inflation. Now, you made a good point on the bonds. So we are shortening the length of the bonds in our portfolio because we're going to anticipate that here in a year or 2 or 3, we're going to be able to buy new bonds paying higher interest. Now, I think it's important for clients to realize the inverse correlation of bond prices and interest rates. Do you mind elaborating on that for a little bit?
Right. So as interest rates rise, this is the main thing with bonds is the interest rate they bear and the interest rate in the market. So as the Fed does increase our interest rates, we will see the prices of the bonds that people currently own, they will go down in value. That is alarming because bonds are, to people, there's the safe haven, they're where you go to if things get bad. One thing that I will say is though, that even though the bond prices will fall, we ultimately are looking at those for repayment at maturity. So the price may fall in the short term, but at maturity, you will have collected your interest payments on that bond, and you also will get back the face value of that bond. So as long as you hold to maturity, there's really nothing to worry about for these bonds. We are investing in great credit quality companies, so default on these companies is very low. So it may be alarming in the short term here, but just know that once those payments are repaid, your money will be safe.
Right, right. And that's huge, I think, because again, for many of our clients too, they've really only seen somewhat of a decreasing interest rate environment. So their bonds have actually paid interest and gone up. So like you're right. So the inverse is going to happen when the Fed starts to raise rates. If you're looking at your statement or your performance report, your bonds are going to show up as negative. And that's a good point. So basically Navickas is getting at, don't start calling him. If your bonds are, you can, but the point is we know that's going to happen and we're okay with it because just like you said, if you put $50,000, if the $50,000 is what you're going to get at maturity from a bond, and today it's showing that it's worth $48,000, but it's still paying you 3 or 4% or whatever it's paying you, that's fine. Because again, at maturity in 2, 3, 5 years, whenever that is, you're going to get $50,000, regardless of what it says it is today. So I think that's very important. I think that's another big reason why you should not own a bond mutual fund right now, in our opinion. I think bond mutual funds are going to have a tremendous headwind because if rates go up, bonds go down. But what happens is if you're in a fund with other people and other people sell those bonds in the fund, you are locked in on a basically a loss where all of our clients, they're individually owning their bonds. So they're not pooled in with other clients, which is a lot more to manage on our end, but we'd much rather have it that way than have to manage a pool and start locking in losses. So it's a huge, huge issue for bond mutual funds. And if you have one, whether it's through your broker or advisor or in your 401k, you should probably give us a call because we could talk about maybe some alternatives to look at because it's going to be a tremendous headwind. Wouldn't you agree?
I certainly would. Yes.
Yeah. So those bond mutual funds are something that you're going to have to watch pretty closely. Good. So we've rotated the stocks and the stocks that we feel, and again, it's important to remember, and we talked about this a little bit yesterday, that the stocks in our portfolio also, yes, we get frustrated because January was a negative month in the market, but that doesn't really matter to our clients. And maybe you can elaborate on that a little bit of why investors shouldn't get caught up on the day-to-day, week-to-week, month-to-month swings.
Right. So, the day-to-day, obviously, CNBC can instill some fear into people when we do see this volatility, but it's day-to-day moves. We are looking at an investment for a long time frame, a long-term investment. We're probably looking at the 5 years of a company we've invested in. And so these day-to-day moves, although they are alarming, they're really not concerning to us because in 5 years, we do believe these companies will be far ahead of where they started, where they at today. So even though that we're going to see some short-term headwinds, we really do not think that we should be too alarmed by that. And especially we have, for most clients, a bond portion of their portfolio. So in the instance that you need money, we can go ahead and take from your bonds and let the stocks in your portfolio, go through their ups and downs, which we fully expect for when you finally do need the funds in 5 years or 10 years from now.
Yeah, really good point. And thank you for sharing that. So that's exactly right. I mean, we are watching it every day, every week, every month. But the stocks in your portfolio should not be in stock. The money in your portfolio shouldn't be in stocks if you need the money within 5 years, right? Because you're going to get these day-to-day swings. Now we're going to trade it. We're going to buy, we're going to sell, we're going to trim, we're going to rebalance, and all of those things. But you're right. That's why we want those short duration bonds, because they won't be as susceptible to interest rates and inflation. So if you need cash and you need to sell something, you've got plenty of dry powder in these short-term bonds that should be relatively, unchanged based on rising interest rates. And that's why we do that. It's very intentional. It's also important to remember that many of our stocks pay dividends, the bonds are paying interest, all that's going into cash as well. So you want to have that cash flow structured. And almost every single one of our clients we've set up to have at least 5 years. Many of them have 10 years worth of money in bonds and cash, right? And so we want to make sure that we can weather storms like this where we have a bad month. Well, you know what? I don't like it any more than anybody else. Again, our revenue is derived from the value of our clients' accounts. So we want it to go up probably more than some of our clients. But the money you need to live off of, to pay your mortgage or go on vacation or buy groceries, should not be in stocks. That's no way to live. So good. So did I miss anything else, Matthew, that you wanted to talk about as far as how we're beating inflation?
Yeah, I think I have a cool little fact that I can share about beating inflation and just the overall market. I was reading this morning, actually, a note from Blackstone, and they were saying that since 1995, when they have seen interest rates increase by 50 basis points, over the next 3 months, they actually saw the stock market rise over 3%. So I think that's a cool little thing to just think about, that even though we may see interest rates rising, you can think that maybe some of that's being priced in now. They're anticipating that rise, and it might allow for an easier path going forward for the market to actually increase instead of decrease.
Really good point. Really good point. And it's another reason that we don't like using ETFs, because I think what'll happen is certain sectors too will do better than others based on that. So, but you're right. Just because they're going to raise rates doesn't mean the market's going to crash. And again, the point is we already know that. The market already knows that, right? So it's not, but the volatility is how much are they going to do it? When are they going to do it? How are they going to do it? Like you said, so a lot of that's priced in. So again, we're beating inflation. And in my opinion, and maybe you can agree or disagree with this, but aren't stocks also one of the best things to own to beat inflation, historically speaking?
You're exactly right. I mean, like we said, inflation annualized was around 7% from the last reading. I don't know if you're going to find many bonds out there that are paying you 7%. So the way we go ahead and beat that inflation would be with equities. So yes. We still want to hold equities even through the rising interest rate environment.
Yeah, exactly. That's history has proven, and again, that's no guarantee of future results. But in the end, if you want your portfolio to keep up with inflation so you can pay more money for gasoline or groceries, then having that stock component in there is going to allow that growth to help you overcome inflation and beat it. And then again, on the bond side, got to keep bonds. We don't want to go all stocks with most people. And so we want to shorten that duration on those bonds so that when rates are higher, you've got more money to invest in higher yielding bonds that can set up your portfolio again to make more interest than if you buy a 10-year bond. I mean, what's a 10-year corporate bond paying even right now?
I actually don't even know, because we're not even buying those right now. I mean, we're focused on the short duration here, but I would expect somewhere around 3-4% at most. But like I said, I'm not quite sure, because we're focused on those shorter term bonds.
Right, exactly. I mean, a 10-year government bond's paying less than 2%. And so you're right, maybe 3 or 4, depending on how risky that corporate bond is. So my point is, why would you want to lock in something for 10 years now at that rate, when maybe we can, and again, nobody knows for sure, but maybe we can wait a year or two and get you 6% in a corporate bond, right? That'd be a much better thing to lock in for 10 years than 3%. So that's what we're kind of waiting on, and staying nimble and managing that. And that's why, it's half of what we do. I always tell clients this, that half is very deep financial planning, tax planning, retirement planning. And the other half is doing exactly what Matthew and Abby are doing, is looking at all this stuff, managing it. And our clients have confidence in us that we're going to take the macro environment and make good decisions based on it. All right, good. Well, thank you again for joining me, Matthew. You're not off the hook yet. I'm going to give a quick plug, and then I want to hear some fun facts or anything you got going on kind of personally in here. Maybe we could talk about the Chiefs, or maybe we shouldn't. But so thank you again for tuning in. The best way to make sure you don't miss another episode of Upticks is to subscribe. If you're listening to this on your favorite podcast platform and you think it's worthy, a 5-star rating would be great, or a thumbs up on YouTube. You can find me on social media. I'm on Facebook, LinkedIn, Instagram, and Twitter. Falcon Wealth Advisors is on the same 4 platforms. If you have any questions for me, my email address is jake@falconwealthadvisors.com. Matthew, what's your email address?
My email is navickas@falconwealthadvisors.com.
Perfect. Yeah, we had another Matthew who kind of took the Matthew or the Matt, but we call you Navickas. Hopefully you like that. People like their last names. So do you have any fun topics? Have you watched any cool shows or read anything, or you want to talk KU basketball or Chiefs football? You got anything on your mind?
Well, the Chiefs, I'm still devastated by our loss, but we'll be back next year, ready for that.
Some people are saying, real quick, some people are saying, and this is kind of extreme, that and I think it looked like this, but I'm not saying he did it, but didn't it look like Patrick Mahomes threw the game?
We're on a big platform here. I don't want to spread a conspiracy theory.
Well, no, and I'm not saying he did, but it looked like it to me. But the guy has a ton of money. I mean, what are you going to give Patrick Mahomes to throw a game? Why would he do that?
I don't know, but I mean, that's my thought too, is we were so dominant in the first half. I mean, we could not be stopped. Like you said, he could have thrown the game, or he could have just gotten his own head so much after making the decision to not kick the field goal and go for one more play at the end of the first half. But it was a collapse that, I mean, we're used to it. We're Chiefs fans. We've seen it happen before, but I think with Patrick Mahomes and the firepower that we have, it was just, I couldn't believe my eyes. But now I'm on to KU basketball. Hopefully we can get things into full motion there, and hope for a good ending to the season there.
Did you know anyone that went to that Kentucky game with KU?
I don't think so. I was looking at tickets. They were expensive.
Yeah, because I've got a client who's a huge Kentucky fan, believe it or not, and he wanted to go, and I was like, I'm not paying that much. KU, yeah. I mean, Allen Fieldhouse is the best place I've ever watched a basketball game, easily, and it's be kind of fun that, you know, my wife went to KU. He's a Kentucky fan. He was going to bring his wife, so it'd have been cool, but I wasn't going to spend that. But man, Kentucky looked really good.
They looked really good. KU did not have it that day, and I hope they figure some things out, because
I've seen KU look like this year, almost like the market. I mean, some games KU has played, they've looked like the #1 team in the country, and then other team, I guess that's just being a college athlete. I guess it just happens.
Right. Yeah, there's inconsistent play, and KU's still trying to figure out their lineup for the year. So that's something they're gonna have to figure out to be a threat in March.
I think Bill Self always does that. And maybe that's just because he gets new players every year now, because a lot of one and done. So like, I feel like KU kind of always get a lot of hype. They're always ranked really nice. Then they might like rattle and lose early on. And then he just slowly gets them better and better and better and better. And then by the Big 12 championship, they look really good. And so that, to me, maybe that's just my observation. So it'll be fun to watch. You got any shows or books or anything you've been paying attention to?
I guess I haven't watched many shows recently. I've been studying quite a bit. I have my CFA coming up here towards the end of March, or February actually. So I've been really focused on that. So no new shows right now.
Yeah, good luck on that. So the CFA stands for Chartered Financial Analyst. It's the premier designation in our industry when you're looking at analyzing companies. There's 3 tests, and you can only take 1 a year, right?
Yeah, it's a long process, a lot of material to learn. So definitely learning a lot, but it's a big test.
Yeah, well, good luck on that. We'll be rooting for you.
Thank you. I appreciate it.
So good. So I know that's all the time that we do have for you today. Thank you again, Matthew, for joining me on Upticks. Thank you all for tuning in, and we hope you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.